everyone, and welcome back to another StockCharts TV segment of Mish's Market Minute. I am your host, Michelle Schneider, aka Mish. So once again, have another big agenda for you all today. Just to review what we're going to cover, we're going to first look at the overall theme, which is the great divergence between the economy and the market. It's a statement that in particular Stanley Druckenmiller talked about this week, in that the divergence was so great that he felt that the risk reward at this given time is the worst that he's ever seen in his entire trading career. Now, of course, that doesn't mean he's not necessarily trading, but in a general, I think he's talking more about the passive type of investing. But nonetheless, it's something that we're all considering here as traders, and of course have had to make a lot of adjustments in terms of our time frame, our risk, and what we're looking for in profit. So with that, we're going to examine the weekly charts on the economic modern family. I know a couple of weeks ago I showed you a few channels and wedges that we had seen that were very important. We'll see where those are at today. Plus, also, we went through phases last week, so we'll also examine these phases. Then we're going to do a deeper dive into small caps, but these are the small caps that are actually been outperforming over the last few months and are very interesting to look at because they sort of fit this mega theme that's been coming up about what life is going to be like after the pandemic, or even as the pandemic continues. Then we're going to take a look at treasury bonds, investment grade debt, dollar, and Bitcoin. So by the time we're done with all of that, we'll have a really good overview. And then we'll go into the commodities, the gold, silver, miners, grains, gas in particular, I'm very interested in right now, and then some of the soft commodities. And with time permitting, follow up on Disney, which I showed you last week, and then one other setup that I think is pretty interesting. So let's start with the great divergence between the economy and the market and examine the weekly charts in the modern family. So I always like to start with Grandpa Russell, as I like to call him, because it is really the granddaddy of the U.S. economy. And this is one of the places where you can see the divergence in the economy and the market sort of side by side, because as we know, the NASDAQ has done extraordinarily well as a couple of other sectors, which we'll get to, whereas this has actually been struggling ever since the big crash that we had in March. So now, we had shown you this wedge last week. Now, I had to do the screenshot capture of these charts pretty early to midday on Thursday, the 14th. So the closing levels are not up to date. Today, IWM closed at 123, so pretty much right about here. That's at the end of the day on Thursday. So really what we're looking at now is this wedge did break down, but again, these are weekly wedges, so if this can actually come back and really get through, say, 126, 127, then we did not violate the actual trend line, and it would mean that as we were going into next week, whatever this correction was, it was particularly shallow, and we could see now if we would get some follow-through, maybe most conservatively, I would wait for a move back over 130. So the IWM, though, has not filled this gap, and that's why with the manufacturing sector and the economy slowly opening up, we're going to be very curious to see if the optimism and the hope spreads this to this particular sector. Now, if we go on, this is granny retail. Now, of course, retail is an important aspect of the modern family because brick and mortar retail in particular is 70% of the gross domestic product. And again, the divergence between the economy and the market, they're predicting that the gross domestic product is going to be abysmal the next time it comes out. So essentially, as we go back here, I had shown you this channel, which wasn't perfect, but it gives us sort of a line in the sand at 37.50. And although we had closed above it last week when I was speaking with you, here we are this week. And XRT actually closed a little bit higher, right around here. So what we're going to be interested in now in terms of support levels is if it holds 35, because if it doesn't, that would probably mean that we're going to see more downside, and in every sector, I would imagine. And conversely, if we can get a weekly close back over 37.51, that would be a good side of the market. Now, XRT is mainly brick and mortar retail, but there is a component to it of Amazon. So that's one of the reasons why now it may be performing a little bit better than all the bankruptcies we've been seeing over and over in some of those big chain stores. Now, IYT, if grandpa is the supply side, this is the demand side, so this is transportation. And again, I had shown you this great big wedge right here that it had broken down from. And now here we are. This closed actually a little bit better. This closed right underneath 140. So we're going to call this 140 to 142 pivotal, which means as we're going into the day on Friday, if we get through 142, I would take that as a more positive sign. And if we break down, I'd say really under 133, then I would think along with XRT and an IWM, if it can't get back over that 126, 127, we're really seeing what Druckenmiller, speaking of, will call the inside of the market. And if the inside of the market cannot perform well, as we have seen over and over and over again, is eventually it drags down even the stronger sectors. Now, if we move on with the family, we'll go to IBB. Now, if you recall, I showed you this really nice big channel right here that broke out last week right on the close on Friday. It immediately gapped up, and this is such an interesting looking candle right here. This is sort of what we would call an inverted hammer doji. Of course, we still have one more day left of the week to get through. But more importantly is the question going to be is, will this hold that 128, 129, which is really where the channel broke from. So again, that's what we're going to look at. And considering that this breakout took this to new all-time highs that we had not seen since 2015, the other big question is going to be, what comes first? A double top, potentially? Anything is possible, or just more consolidation and then we blast through those highs and continue to make new highs in what would be considered a sector that would make sense, considering that it's pharma, and a lot of what's going to move the countries forward is going to be if there are better treatments and we get closer to a vaccine. Then we have Sister Semiconductors. Sister Semiconductors has been an outperformer for quite some time. I had shown you a wedge a couple of weeks ago. I actually kind of fixed it a little bit tighter here because now we have 3 beautiful points on the wicks of the candles all holding, which makes this an extremely valid trend line. Now this too closed higher. Semiconductors actually closed up at 134. So that was more like here. What's really interesting about this is, number one, is with this week's low, right here, we do not want to see this breakdown under this week's low. And of course, as I just showed you with the other sectors and grandpa, is that if it does, you know it's going to be partly because those things have failed. However, and we have to really be sort of this sort of if-or kind of situation right now in the market because there is a lot of negativity around. The breadth is negative. In fact, one of our models that have been long the S&P 500, which is a quant model, is actually exiting on the open tomorrow. So generally, those trend strength indicators that we use really are been very, very reliable. So even though we're seeing the price up a little bit, considering where we're at in the charts, besides in semiconductors, it could be telling us that this rally really is getting tired and today was just another last gasp of the dying patient, so to speak. If it though gets through 135, 136, then the next place we'd be looking at would be what happens as we get to the top of this channel right here. But again, semiconductors, IBB, when the market is holding up, have been the best places to go to buy, and they continue to be so. On the other side, semiconductors often, as Wonder Woman, as I like to call her, looks around. If the rest of the family isn't around with her, she actually starts to sell off. And then finally, we have regional banks. Now, regional banks, again, has over and over and over again given us clues as to what was going to come in the market with its weakness. Now, today, it looked like today was going to be the day that it would just completely fall apart, but that did not happen. Instead, what happened was it got down to 30, once again, tried to test that level, found support, and along with a lot of the financial stocks, this actually bounced. Now, this closed at 32.40. So just really about right here, okay? So it's not exactly like it's strong, but nonetheless, at least it held up. So this is going to be another key tomorrow. If we break down under 30 or 29 in particular, which was the low from last month, well, 29.19 to be exact, that will not be a good sign. On the flip side, once again, we can get through 35, 36. I'm going to really say more like 37.50. Then we'll have another look at it if it can get to 40, and it still needs to fill this big gap right here. So the modern family is mixed and also mostly weak. No doubt about it, with a couple of strong sectors hanging tough, but not necessarily tough enough if we do not get cooperation from everybody else. Okay, let's go on to the other branch. Sort of stumbled on this week, which is that there is a whole other ETF to look at that measures small caps, but really measures some of the higher earning and bigger small caps. When I say bigger, I don't necessarily mean in capitalization, but bigger in terms of their financials are more solid. And I found that to be really interesting, so interesting, in fact, that we at Market Gauge are actually creating a quant model based on certain formulas to find some of these top outperforming and keep it within the small cap index. So that will be very interesting when we finally are ready with that. So let's start right now with a look at VBK, which is the Vanguard Small Cap Growth ETF. So that's what we want. We want things that have our growth stocks, but small capitalization, which means they're nowhere near as large as an Apple or a Facebook or an Amazon. But that doesn't mean that they aren't necessarily the next emerging trend if the market could actually hold up. So if we're looking here at VBK, what we see, of course, is let's examine the phase. So last week, remember I told you that if the 50 is above, below the 200, but the price is above, it's a recuperation phase. And if the slope is negative, it's a weak recuperation phase. And that's kind of what we have here. And of course, the cyan line will be the 10-day moving average. So price-wise, it tried to get through the 200, and it failed to get through with the recent move down that we've had, and it's come back a little bit today. In fact, it closed at 175, a little bit higher than this at 175.16. Right underneath that 10-day moving average. Now, of course, we also like to look at a couple of other things. One is volume. So you can see the volume hasn't been that great. It was big on this day right here when it went and crossed the 200-day moving average. But that was sort of almost like a blow-off type of situation. But now let's move down to our indicators that we are still planning to release, I think June 1st, for you all to be able to add to your charts. And so right now, you'll just have to be stuck with me showing them to you. But this is the price performance. So this is the price performance against a major benchmark. So you can see now that it's outperforming, and it's been outperforming the SPY in this case, holding the moving averages, but really no divergence between the come down in the price and the come down in the price performance. If we go here to the real motion, this is the momentum indicators. Take a look here. This is the 200-day moving average. This is the 50. So right now, this is well above the 50, just like this is. And look at how when the actual price cleared the 200, this did not clear the 200 in momentum. That's why we like to put this all together, because we would have not been caught long, not to mention the fact that I told you guys when we discussed phases that you really want to have 2 days of a confirmation in order to say it's a solid phase change. So what we would be looking for now is for this to cross in the real motion over that moving average, and the price get close to, if not take out, the 200-day moving average. And then I think, we would have an interesting situation here, at least in these growth stocks in the small cap. Now, I want to show you two particular stocks that are in this index that I really like. One is HubSpot. So HubSpot is a cloud-based sales and marketing tool and technology, but it's not a technology in the semiconductor space or obviously in the NASDAQ space. So essentially what this is a stock that deals with you being able to do a lot of customer reach out, for lack of a better word, using the cloud. The ATR on the, whoops, geez, I have no idea why that happened. Sorry about that. Very tricky little mouse here. This ATR right here, this is the average true range, which means it's what the range is over 10 days on average. It's $10.57. And I tell you this for the reason. So now what I'm interested in this is right now we're in an accumulation phase because the price is above the 200, but the 50 is still below. What I do like here is that this is neutralizing in slope, as is the 200. Today, this actually closed a little bit higher up here at 181. Well, not quite that high. And this has definitely been looking pretty strong. It made a big peak high here back in February before the crash. And now, even with the correction that we had, say, in the SPY and in the IWM, this did not correct as much. This is why it's an outperforming small cap stock. So now the question is, what would we do from here? Most likely, I'd be looking at this a couple of ways. Number one is, generally, if you want to have a swing trade and you have a forward-thinking outlook that the market could hold and rally from here, and of course anything's possible in this divergence, I wouldn't necessarily bank on that, but that would be one thing that you could actually risk to under the 200 or under 162 and still have, we like to say, up to 2 ATRs of risk. So you don't want to go more than $20 of risk, but figure about $15 of risk. Now remember though, that you have to look left to look right. So is it possible that this thing can go from 185 to 205? Well, that's where you get the information. It's been there already. So that's why this is not a bad trade as far as we're just looking at the chart and the price. So that's one setup to look at for Friday, or if you wanted to wait till Monday. And particularly, like I said, now we have kind of a pivotal point here at the 10 at around 175 for a more active trade. Now, if we go down here, this has been a leading stock. There's no divergence between its price performance and its actual price. What does give me a little bit of pause here is that we had a peak here in momentum, and yet the momentum did not clear the high momentum from here, which is interesting. So if we can get a move up, at least in the momentum a little bit, and it is holding the moving averages, by the way, then that too would be another good sign. So I wouldn't say it's not good momentum. I would just say that the momentum is showing no divergence in the price, and the price performance, if anything, is showing that it's still well outperforming. So it's not a bad thing to look at. Another stock in that space is Zebra Technologies. Now, Zebra Technologies is an app that uses barcodes to share information. So you are a healthcare provider or a retail provider, you can then use barcodes to be able to see a lot of information all at once from all over whatever it is that you're looking at, different hospitals or different retail chains, etc. And so that, again, anything technology-wise, particularly in the small cap space, interests me. And as I recently said in Yahoo Finance when I was on there earlier in the week, if the idea in this seismic shift that we're having is to find things that are going to really be more in line with the lifestyle that we're going to have as a result, then you want to find things that aren't Apple and Facebook, but you want to find the next Apple or the next Facebook. Now, I'm not saying this is, but I am saying what's interesting about this chart is a couple of things. You see this big spike in volume right here? This trades on average 400, 500,000 shares a day. This particular day, this traded 11,578,000 shares, and I thought, why? So I looked it up, and they had actually applied for a waiver to use their technology, which right now is only good for indoors, to outdoors, so that they can expand their barcode usage with sports venues and airline personnel, etc. So really, it's a way to track. It's a tracking system, and we're very much going in that direction. Also, the ATR in this is pretty big at $9.92. So now let's take a look at what happened here. Number one is we were up here up until this recent correction. Now we closed in this one at 221.99, so just a little bit above this 200. So we're actually cracking back above the 200. So let's go back to what I told you. If it confirms on Friday and closes above 221, you actually can have have a pretty tight risk in this, risking to underneath today's low, which was at 215.52. So I always like to give it some fudge, so figure under 215. That's not a bad risk reward, because if you're going to get in over 222, if it breaks out on Friday the 15th and risk to under 15, you're looking for $14, which means you're looking for 236. That's actually pretty close by. So where a zebra might, where HubSpot may be somewhat used for an active, but also potentially a swing if you believe in the market, this to me really sets up also for both. You can either do it as a swing or you can do it as an active. Now, let's take a look here. This actually started to underperform the SPY, so that's something we want to see change before you went in and gangbusters. And even though it's piercing the 200-day moving average here, look at your divergence. It's under the 200-day moving average here. So this really needs to prove more. So that doesn't mean it's not a good trade, but it would not be something that I would certainly go in full gangbusters with. I would be more cautious based on the setup, consider it an active trade until I started to see the momentum catching up, because this is a true divergence right here. Okay, let's go on now. And I better move a little faster because I've got so much more to show you. So let's go to the T-bonds. So this is the treasuries, and let's focus so much more again on these divergences here, because there's a big divergence in this one. This is the 50, so this is the 20-year treasuries, TLTs. This is the 200. The price gapped up today. Of course, it's already been higher than that, and it broke the 50 and it came back. So it's showing good price performance today against the SPY. But look at this. Even though it's above the 50 in the price, it's below the 50 in the real motion. So that tells me that if this comes down in price again, let's say breaks under 165, then most likely you can see the yields rise. What that does in the market remains to be seen. It's been all over the place, but of course there's a lot of talk about the yield curves, and also the fact that the Fed said that they weren't necessarily in a big rush to go negative on the rates. Now you want to look at LQD. Now LQD is different. This is the investment grade corporate bonds. The reason why we want to look at this is the Fed announced that they were going to buy this outright. So again, we're above the 200 and the 50. We got today a little bit higher, close around 128 above the 10, but let's go down here. Yes, outperforming the benchmark by a little bit, but once again, we're above both moving averages on the price and not in real motion. So this too would not be something I would necessarily buy, but for information, this would be very interesting, because if this starts to fall apart, considering what the Fed's action has been, that would not send a big sign of confidence to the market. Now, this one is the dollar. This is, I tried to find DXY, I couldn't find it. Obviously, I still have a lot to learn about StockCharts platform. But I did find UUP, which is the ETF for the dollar. And so there's been so much debate about the dollar going up, the dollar going down. Here's my take on it. First of all, we have not broken out over 101, and we're still so far from the high. So people that just think that the dollar is just going to go up and up and up and up really are facing some pretty strong headwinds. I myself am looking for something different, and that's partly because of this. First of all, yes, it is outperforming, but also now we're into some resistance. But here to me is the more important thing. Once again, like I just showed you, outperforming on both the 50 on the 200 here, underperforming here because it's barely over the 200 and it's not over the 50. So if you start to see any kind of sell-off in the dollar, and this momentum indicator here breaks down under the 200, then you could see the whole landscape of strong dollar change. Now, finally, on this level, I wanted to show you Bitcoin. Bitcoin actually has done very, very well, and this is part of why I think that people like Paul Tudor Jones came out and said that about 1 to 2% of their portfolio now is Bitcoin, because there's a lot of talk about most currencies going to be possibly in jeopardy for lots of reasons I won't get into now. But Bitcoin has been the winner as a result. So right now, no divergence here other than we're getting close to the high that we had. The higher momentum is much higher than where it is now, so it might peak out a little bit and have a little bit of correction, but something to note. Okay, quickly, I'm going to move on now to the commodities, because this to me is really interesting. First of all, well, let's take a look at gold. Now, I do post my daily on StockCharts, and I wrote a whole article about the compression in gold and what happens in physics when the compression is released. You have what they call a compression force, and this certainly happened in gold. So right now, it still has, I think, a big move up in it, and the dollar will be a factor, the bonds will be a factor, fear will be a factor, what happens in the market, all of that will be a factor, but nonetheless, we've been long gold since down here. So right now, we're looking at the fact that of course, it's outperforming in price. The momentum is good, but not great. So we want to see this momentum start playing some catch up. And remember, over the last couple of weeks when I showed it to you, I said momentum showed that this thing wasn't ready. Now it could start getting ready to blow. Here's silver. Silver today, finally, actually yesterday on Wednesday, it made its best close in a month. And now today you can see that it closed even better. Actually, the closing price in silver, just to be accurate, as of Thursday was $14.83. So it was a little bit higher than what you're seeing here, 10 cents higher. But what's important is A, you had some volume to follow that. B, it's really outperforming the SPY. And remember, I showed you a couple of weeks ago that even though this was sitting right on the 50 on the price, the real motion had actually cleared the 50 here. So now we want to see if this thing can keep going and see that the 200-day here and the 200-day are actually somewhat in line. But silver looks very bullish, and yes, we are long silver, and we even added to that the position last week. And now the miners, same thing. I had shown you the miners a couple of times. I said once this thing took out highs over the last several years, it was probably pretty much a no-brainer. Today, it actually closed at 35.11, and it was the highest close that we've had in 7 years. Okay, so we have the price performance showing, and the momentum, same thing. We made a higher momentum the last time we were near these highs. We want to see this momentum to keep going, but right now we're certainly in line with the trend. Now, quickly, if we move on to the agriculturals, because I've shown this to you week after week after week. This here is DBA, so this is the one that encompasses wheat, sugar, not sugar, wheat, soybeans, corn, etc., and some of the livestock. And again, what I keep showing this to you is A, because food demand has been high, food prices have gone up, but we're not seeing it reflected yet in commodities. It's when we have real shortages that you go to hedge in the commodities market. Price, though, performance, even with this piss poor price performance here, is showing it's still outperforming, and it was over the 50 when this wasn't. Remember, I told you we had waited for a phase change confirm that never happened. Now it's back below the 50. Now we want to see what happens if this gets back through the 50 here with its outperformance. Again, maybe worth a probe, or to be conservative, we can wait for that official phase change. Now, this is something we actually bought on Thursday. This is the United States Gasoline Fund. The reason why we bought it is, even though we have a negative slope here on the 50-day moving average, let's go down. It started outperforming on the price against the benchmark all the way here when the price was still down here. I wasn't paying attention at that point, but nonetheless, that was one little interesting signal. The other thing is it broke out over the 50 on real motion when this was still below the 50-day moving average. So now that this got over the 50 and corrected to it, when I looked again today, see this little pip right here, this shows that momentum is gaining again. So I thought, and this actually closed at 14.92, we bought it around 14.40, tight risk, to see if we can get up to around 16 as our first target, which would be around here, and keep going. From a fundamental standpoint, if people start doing more driving, airlines start flying more, this would have a lot of room to the upside. Cane. I like to show sugar, again, especially when it's a divergence. I would show you the sugar futures, but that always assumes that people can trade the futures. Most people that work with me do not trade futures. They trade the ETFs of the futures. So this doesn't look great, but you can see here, once again, it's pushing against the price performance, and it's also still very low here in terms of the actual momentum. But if we can show that this is a sign, I would keep an eye on this, because if this thing can take out 550 or so, this finally might be worth a shot, especially as we get closer to the 50-day moving average. And I unfortunately am out of time, so I'd like to thank you all very much for watching. I'll be back with you all next week. And please, I love the comments on the YouTube site. Ask me any questions. Find me on Twitter at Market Minute, and you all have a blessed weekend. Thanks so much, and bye for now.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.